The presentation today we're talking about taxation treatment of trees, and in terms of that we've got to be very careful. I have no conflict of interest again. I hope you enjoy and take something away from this information, but it's really important to understand that this is not providing financial advice. This is providing enough insights for you to talk to your own individual advisors about your own individual circumstance to work out what you need to do. And that's really, really important because there's so many different machinations of how tax works that we need to make sure that everyone treats their own situation as an individual. So in terms of the process today, again, acknowledgements in terms of people who've helped out with this project. Obviously, again, Liz and Amy for collaborating and getting something going in one parcel, but also fundamental thanks to Daniel and Renee at Gelpins who helped out with some of the information, some of the clarifications. And I'll put a bit of a personal spin to it. I didn't do very well at school. I was too busy trying to understand what they were telling me rather than playing the game of just regurgitating information. That's the same thing here. In this whole project, rather than just spitting out stuff, we try to look at how it works, understand what the actual mechanisms are and how they apply to different circumstances. So it's about understanding the system, understanding how it works, and then with individuals going back and applying it to your own circumstance. Okay, so we'll go through some fundamental concepts, talk about farmers and farming, so some of the motivations, then look at taxation mechanisms and the history of trees. There's a long history of tax and trees. Look at primary production, a forest operation, which is a specific thing under tax, and then plantation expenses and some case studies. All right, so there's some fundamental concepts. Everyone's heard the old adage of there's nothing more certain than taxes and death. This is completely wrong. Death's pretty certain, but taxes are not. There are so many different tricks and systems and different parts to tax that it just depends on your circumstance. So there's nothing certain about it. And you can, as a person, go from paying 45 cents on the dollar to zero tax with trees. And that's all legally. It's not by some bottom of the harbour scheme, some Cayman Islands tax dodge. The system is set up so you can actually, with the right structure, pay zero tax on trees, on that income. The next fundamental concept about tax is it's all about timing and time. It was mentioned before about there's a whole range of grant systems coming out to assist people with growing trees. Timing is critical. You get the money before midnight on June 30. You spend it after midnight, June 30, 1st of July, you'll get taxed on that money. If you get it before June 30, spend it before June 30, you won't get taxed on that money. It's all about timing. The whole tax system works on timing. Timing of what you do, when you do it, timing of your own age. If we look at the question now, thinking about the farmer, it's really important to understand what is a farmer trying to achieve as an individual. And when we looked at the whole process of succession planning and retirement, it was really important to understand how tax work. I went through reading a few documents about succession planning, and one of the authors talked about the 4 D words of including death, divorce, disagreement and disability. And when we were talking with the Gelpins team, we sort of joked about, well, do you really say I do one day and go and plant your divorce trees? It's probably not a good look, but people are using trees for all sorts of mechanisms in their private circumstance. And one of the situations we've seen in one of the quite prominent farm foresters in Tassie, he'd used trees on his own private enterprise to provide funds for the children who were not going onto the farm, so to take away the pressure on the kids that got the farm to having to pay out the rest of them. So trees can be used for all sorts of mechanisms. So we think about trees and timing. Trees, they're relatively predictable. We've got 2 basic rotations, short rotation eucalypts, long rotation pine. If you're thinking about your future and planning, you can sort of look and say, well, how does this crop fit with my particular circumstance? It's relatively predictable, so you can start to use those to your own advantage. If we think about the farming enterprise, farmers are growing trees for a range of reasons. They could be part of the enterprise benefit, shade and shelter, stock protection. They could be for carbon offsets. Interestingly, when you talk to the agricultural sector, they're actually advising agricultural participants, so farmers, not to sell their carbon credits, to keep any carbon benefit on their own property to offset their own emissions, to supply Coles and Woolworths with carbon neutral beef. So it's got to be a really careful step. Do you sell your carbon credits? Do you keep them for yourself? So it's a really fundamental choice. There's environmental benefits, so you're actually protecting the environment, you're improving your landscape. There's also amenity and aesthetics. One of the farmers we visited during this process said that they're finding it easier to keep employees on properties where there's lots of trees because it's a better environment to work in. And then in some cases, people just like trees, so they're planting them for a whole range of reasons. If you look at the enterprise structure, and this is starting to get into the nitty-gritties of how tax works, you can be an individual, like have no kind of business arrangement. It's not a business as such, but you're still growing trees. You can be a sole trader or a partnership, so there's actually a business operation in play. You can be a company, or you can have a trust structure, and a lot of farmers have their family farm set up in a trusting system. And a part of a subset, we can start thinking about self-managed super funds as a way of managing your retirement and that retirement income. If you look at how taxation works, it's administered by the ATO. There's a pay-as-you-go principle where if you're an employee, you have tax taken out of your pay each month, you get your surplus paid to you. And at the end of the year, there's a self-assessment process where you work out how much you earned from all sorts of sources, what sort of expenses you had with allowable deductions, how much tax you've already paid, and there's a recalculation. People talk about having tax deductions. That's actually wrong. What you get is a reduction in your taxable income base by expenses. Your tax is recalculated as a bit of a reckoning, and if you've earned more, you pay more tax. If you've earned less because of these allowable deductions, you get a tax refund. For a company, it works in that they earn more, they pay more tax. If there's a loss, that loss is carried forward to the next period when they actually earn income as a surplus to offset that future surplus. So in terms of providing the story about tax and trees, you've got to really understand the framework in which the tax system is working for those trees. Trees have a long history with tax, and we'll get this one off the table right from the start. We're not talking here about managed investment schemes. Managed investment schemes were at tax as a financial product. The underlying asset in which the money was invested were trees, but the financial managed investment scheme was a product. It's not really what we're talking about here as direct investment in trees. So when you look at non-MIS planting history in Australia, and I've looked at Australia, New Zealand, Uruguay, and US and Europe, you can see tax treatment favourable, trees get planted. Tax treatment changes, trees stop being planted. And there's this, you can actually map the planting history with the changes in tax treatment. So tax is a very powerful driver of tree development, or stopping it dead, depending on the circumstance. So in terms of the process that's actually doing those changes, it's about how the expense of establishing the trees is treated. Do you have to carry that expense forward to make an income, or can you offset other income against the cost that you put into the trees? So those two different treatments are really what drives the taxation stimulus or stopping dead tree planting. So in terms of primary production, what are we talking about? It's a system, which basically is agriculture. The tax office recognises that your incomes are not guaranteed and they're likely to be lumpy, so they have this favourable set of treatments that take account of this practical reality of how how the business is working. When you look at it, they have a number of activities that are classed as primary production. So in this list, we've got plant and animal cultivation, fishing or pearling, tree farming or felling. And that primary production can be taken on as a individual, and that's sort of a sole trader, partnership, trust, or a company. So you've got these sort of broad categories of things that are classed as primary production, but taxation is a whole series of tests. It just depends. And going back to what I said about seeking to understand it, in pulling this information together, I couldn't go to a manual that told me how it works. I had to sort through all the different bits of the ATO website, finding different components to the jigsaw puzzle, pulling it together, then with help from a number of people, distilling it into an actual workable story. So if in terms of forestry, the benefits of primary production, recognising the issues with the cash flows that come from this kind of activity, there's a number of mechanisms. The first one, they have farm management deposits, so the money goes into a separate sort of account treated. If you're a sole trader or a partnership, you can have income averaging, and I won't go into the details of things, so they recognise you can try and smooth out the income over time. And the last one is there's a thing called the non-commercial losses treatment. So what a non-commercial losses treatment say is that you can't offset your other income sources from your expenses involved in activities which could be potentially non-commercial. But there are a series of exemptions to that treatment, which means you can offset the expenses in things like trees against your other income. There's some automatic rules. So if you're an artist earning less than $40,000 a year, or a primary producer earning less than $40,000 a year, you can automatically get this. If you're not, you can try for some of the exemptions to that rule. And the test is, if you earn less than $250,000 a year, there's 4 other tests, you can then claim that. So that means that me as an individual could then offset my core income with expenses in trees and claim that as a deduction to my tax base. So that is a really important part of the stimulus of going from having to take account of my establishment costs at harvest to taking account of establishment costs in the year they occur against my other income. When we talk about trees, there's really 2 types of trees, and Amy articulated it very well. You've got basically permanent trees. So you're planting trees with the view of not cutting them down. So there's a range of purposes for that. So it could be for amenity, environmental benefit, shade and shelter, carbon. So the idea is those trees are not going to be taken off the stump. Then you have the other type of trees, which they're trees for harvest. So they're trees you intend to grow as a crop, cut down, and you do something with. Then there's 2 other bits in between those, where the trees are being grown for wood for your own use, or the trees have been grown for amenity. So neither of those things have any relationship to earning an income. Those are excluded from the ATO treatment. The rest are captured by different definitions and different tests. You can change your mind. You can change your mind from thinking, well, these trees are permanent. You might say, no, they're not. I'm going to cut them down. Or, in cases of some of the larger clients I've dealt with, they had blue gum plantings and really good strips. They were worth a lot of money as blue gums. They said, these trees are worth more to me on this site, providing shade and shelter for my sheep off the shears. So they changed their mind from the initial intent of harvest to one of keeping them for permanent. So you can change your mind. So a specific thing under primary production is a forest operation. So this is when you take the test of how you classify yourself as a primary producer growing trees. You're actually developing a forest operation, and there's 5 components. You have to be carrying on a business. You have to have the intent to harvest. Think about that one. You've got to be planning to cut those trees down. Not only cut them down, but they have to be sold for a profit to someone else. So they're not for your own use. And they have to be done in a big business-like manner, so organising the usual bits and pieces for a business. And there has to be active management to improve the tree growth and performance. So you think about the checklist, you go through all those, you can class yourself as a forest operation, get yourself treated for tax appropriately. So I was thinking about, well, what's the evidence of this kind of intent? Because you can say whatever you like as intent, but what are you really going to do? But if you want to try and prove that your intent is to be a forest operation, I started thinking, what would I look for if I was doing an audit? I'd say I wanted to see the business-like manner, and the ATO have very specific tests of carrying on a business, what you need to do, and that's things like keeping records and accounts. You need to develop a business plan for that particular plantation that clearly says, I have the intent to harvest and generate a cash flow from these trees. Then you need to have a tree management plan that says, I'm going to actually manage these trees in the right way to maximise the tree growth. So you're going through that checklist of the 5 points. And the last one is you plant a commercial species. I won't mention any names, but recently I went to a seminar and they were promoting growing redwoods. If you're thinking about 6 generations in the future, maybe a possibility. But if you're thinking about a commercial species for harvest in your own lifetime, tell them they're dreaming. So if you're planting commercial species, so in the GT, radiata pine or blue gum, you can start saying, this is the evidence that I have an intent to grow these trees, harvest them, sell them and make a profit, because it's a commercial business. So once you've satisfied these requirements, you're then sort of in the area where you can start dealing with the taxation. A key one though, a forest operation, this is under the tax requirements, you are selling logs. It specifically says you cannot transform those logs into other things and then sell those other things and still be classed as a forest operation. So the primary producer status is very specific about that. So if you want to buy yourself a portable sawmill and transform those trees into boards, then that forest operation status is no longer there in terms of that, because you're not intending to sell those trees as the primary product.
So grain excludes wood chips?
It does, specifically. Yep. Which I blew me away when I read that. I'm not sure how you get around it or how it works, but that's what the actual requirements say. Okay, so we think about the whole story of expenses, and tax really is about treating your expenses and how you work with those. Typical blue gum regime, pretty simple, 12-year rotation, upfront establishment costs about $2,000 a hectare. You wait your 12 years, you get your cash flow in. You've got a little bit of maintenance costs along the way, but if you can't expense that operations against your other income, you have to carry that $2,000 for that 12-year period. So you can see why tax on, tax off, trees in, trees out. Now, if you can expense, it makes it much more attractive because you can offset other incomes. And you see that with the gentleman farmer type set who have another income. The farmer's an interest running commercially, but they can put surplus money from their other income into that farm and grow trees. Okay, in terms of plantation expenses, how are they treated? If you can't get that exemption to non-commercial business loss, you then have to expense it, save those losses, carry them forward to the time of harvest. If you can get the exemption, you can claim that up front. So ideally you want to try and get that exemption. Go through those tests and then get the exemption through that. With company trusts, the expenses can be offset against other revenues within that trust within that financial year, but you can't claim those losses as a deduction if you've got an overall loss. You have to carry it forward to actually generate an income. If we think about some case studies now, trying to put some numbers around it, if we look at an individual, so the person's growing trees in their own right, they've been able to go through and seek the exemptions. They're acting as a sole trader or partnership, so pretty routine standard sort of arrangement. They can then use those their other income to develop trees, reduce their taxable income, get a tax benefit from that process. They then, when the trees are harvested, they then pay income on those income tax on the trees, depending on their own circumstance, could be from 0 to 45% on those trees. The next one, if you've got trees in a trust, so you've got a farming business, like a discretionary trust. Discretionary trust basically says all the activities happen inside the trust, earns its income. At the end of the year, financial year that is, there has to be a distribution of the earnings of that trust out to the different beneficiaries who are named in the trust. But it's not set. This year I might give Dave $1, I might give someone else $2. Next year it could be reversed. So the discretion of the trustee is to allocate the money from the trust at the different rates. If they don't and keep the money within the trust, then they're taxed at the highest marginal tax rate. So it's trying to keep the money flowing through the trusts. If we then look at a self-managed super fund, and this is a really interesting beast, in that thinking about how you can actually maximise the benefits. There's two basic phases in superannuation. One is the accumulation phase, when you're putting money into the super fund, both by your pay-as-you-go super guarantee type thing, plus you could be doing salary sacrifice, which is still regarded as part of the concessional treatment. That goes into the fund. That's taxed at 15%. The fund is taxed on the net income, so you could be actually using that income in the trust to be developing trees and reduce the amount of tax that the super fund pays. Once you reach the pension phase, and so there's no more contributions coming in and there's only earnings within the actual super fund, that's tax-free. And the pension you draw from that super fund, as long as there's no other money coming into it, and it's 100% pension phase, is tax-free. So using a super fund can be a really good mechanism to grow trees. There's all sorts of other costs and things associated with the super fund. But like I said at the start, these are the kind of things that take to your accountant and say, what about this? What about that? What does it mean for me? Will there be a benefit? Will I be better off in this sort of structure? So when we think about it, we come back to the clock. Before midnight, on June 30. If you got income from your trees and you were still in the accumulation phase, you'd be paying tax at 15 cents on the dollar of those trees. After midnight, if your harvest occurs, you're in the full pension phase, that income is tax-free, your pension you draw is tax-free, and you've got this big lump sum coming into it. There's rules about how much has to be drawn each time, but you don't have to take all that money in one hit. You can actually start to spread out that income over time. So it's a really useful mechanism to think about. Like I said, I'm not providing any common advice. I'm just sowing its ideas, concepts that people need to follow. In a very simple term here, and again, there's all sorts of other details around it, but just for simple terms, I'm assuming that you've planted 5 hectares a year of Tasmanian blue gums for 12 years. So you're planting up a mini estate. If you're doing it inside a trust structure, even though your harvesting starts at year 13, you've had to carry those losses forward. So you don't get any distributions from the trust until you've used up all those losses, then you start getting that. The money coming out of the trust, going to the different people and the beneficiaries, is then taxed at their tax rates that are applicable, so it adds to their income. If we're now thinking about the other structures, and these are the ones where it gets really interesting. If you look at it from a point of view, get my thing going, you're an individual sole trader and you've got that non-commercial losses exempted, so you're offsetting your other income. You can get your payment in trees with a tax refund coming back because you've lowered your taxable income, so you've paid more tax than you need to, so you get some money back. Then when it comes time to harvest, you've got these trees being harvested, but because you're still you're earning income from these trees, you then tax at your tax rates that you'll be paying. If you've got them inside a super fund, you make your super fund with a salary sacrifice, so you're reducing your taxable income, you're getting a tax return. When it comes time to harvest, and you've in that full pension phase, that income coming into the super fund and your distributions that you're taking off are tax-free. But you have to have the trees in the super fund right from the start. If you try and develop them outside and transfer them in, there's a whole load of pain that goes with that in terms of how much it will cost you. So the smartest thing then is to have them inside the super fund. It's not going to suit everyone and everyone's circumstance, but these are some of the strategies you can do with trees. Remembering those primary tests that you have to have the intent to harvest, you have to have the intent to sell, you have to have the intent to sell for a profit, you have to make sure that the trees are growing well, it's like you can't just sort of set and forget and walk away, and you have to make sure that you're growing something that's commercial and someone wants. So there's a number of ways you can use trees to really significant financial benefit, thinking back to the principle of I'm planning for my retirement, how do I actually make trees work for me? I won't say I'm planning for a divorce because you don't usually do that, but you can make trees work for you in all sorts of different ways. So with that, some takeaway messages. Make this thing to work. Okay, so you need to understand your own personal objectives for the reason you're planting trees. And when I say your own, it could be your own, the family's, the farm. You need to then think about who's the right advisor to help you work through what the smartest way of structuring yourself. And there's some incredibly good advisors in all sort of tax and legal type areas. There's also some very lazy ones. So you've got to find the right person. I've been dealing with the same accounting company since 1988. They know me, I know them, I trust them, and I know they're doing a good job. So you've got to get the right advice to make sure you go forward. You need to consider your total circumstances, not just a little bit about trees, but your complete circumstance, all the income you might be getting from all sorts of sources, and you need to understand how those things work and contribute as a package deal. The last point is you need to think very carefully about how capital gains works. Capital gains is another complete topic that we can spend days talking about. Basic capital gains is not a separate tax, it just adds to your taxation base. So it's another area to think about. So the key message is ask the right questions, get the right advice, and make sure you're looking after your own interests and how this thing works when you're talking to your advisor to make sure they're giving you the straight answers that you need. Again, I'll stress very vigorously, this is not financial advice. This is sowing seeds for some of the options to think about. this is something that will inform you in any sort of discussions with your advisor. So thanks very much, and I hope that was useful.